The Chinese stock market surged Thursday, ending days of massive losses, as the Beijing government intervened to shore up prices. Shanghai's key index jumped 5.3%, its biggest one-day gain in 8 weeks. The gains, all recorded in the last 45 minutes of trading, helped investors recover some of the 23% in losses sustained over the past 5 days. After staying out of the market earlier this week as it plunged, the government resumed its stock purchases. It apparently was an effort to stabilize the market ahead of the September 3 military parade celebrating the 70th anniversary of the World War II victory over Japan. Over a longer period, the Chinese market had tumbled 42% since its mid-June peak, erasing more than $5 trillion in value as traders worried that the stock values were too high, with prices unjustified by China's slowing economy. Other markets also closed higher Thursday, with European indexes advancing in afternoon trading. New York indexes pointed to a higher opening on Wall Street, following Wednesday's 4% rebound in key U.S. stock indexes. With the world market volatility, there were hints that the U.S. central bank, the Federal Reserve, could delay increasing its benchmark interest rate, rather than boosting it next month as some analysts have been predicting. The Dow Jones Industrials, which had suffered double-digit declines over the previous 5 sessions, soared 619 points Wednesday, the third biggest point gain in its history. Global stocks have been in a free fall for the past 2 weeks on worries about the slowing economy in China. China's central bank cut interest rates this week to pump more money into the economy, but is not clear to what extent the move will help stabilize Chinese stocks. Traders at the New York Stock Exchange say it's not China's slowing economy as much as it is China's lack of transparency that is making investors nervous. Trader Stephen Guilfoyle tells VO that investor psychology has been more about caution than panic. And Alan Valdez at DME Securities blames the market volatility on lower volumes typical of the summer months, coupled with uncertainty and eroding confidence about Beijing's monetary policies. Another concern is the value of China's currency. Beijing unexpectedly allowed the yuan to weaken earlier this month, raising concerns Beijing was worried about its exporters, who have helped drive its massive economic growth. On Thursday, China's central bank set its central rate for the yuan at a 4-year low, at 6.4085 against the US dollar, or about 0.07% weaker than the previous day. U.S. Federal Reserve next move. Most analysts predict the volatility will continue until at least September. That's when many economists believe the Federal Reserve will start raising interest rates, which have remained near zero since 2009. Lower rates helped stimulate the U.S. economy, the world's largest, as it recovered from the steep 2008 to 2009 recession. Despite improving U.S. employment and housing data, a voting member of the central bank raised doubts Wednesday on the timing for a rate increase. William Dudley, president of the Federal Reserve Bank of New York, told reporters that recent turmoil in global markets makes the idea of raising rates next month less compelling.